Well, hello everyone. We're here today to talk about actually sector of the month. We're going to talk about small cap healthcare, in particular 3 stocks in the healthcare sector that we own. And Marc has covered small cap healthcare for some time, so pleasure to talk to you about one stock in particular, ACL, which I know we've covered for a long time, that you particularly like in the sector.
That's right. So we've got a couple of key holdings in the portfolios in small cap healthcare. That's a sector that I'm really excited about. Valuations are really compelling. 2 stocks that we like are Australian Clinical Labs, which you mentioned, which is the number 3 pathology player in the country. Now, pathology is a great sector. It's really about volume. So pathology is all about volume. You run your laboratory, it's largely across a fixed cost network. And the more volume you can put through your laboratory network, the higher your operating leverage, the higher your scale efficiencies and so on. So really that's what gets us excited about Australian Clinical Labs. And if you look at their update at the AGM back in November, top line's growing at around 5 to 6%. And that's roughly in line with what we think are the long-term averages for the sector. So that's been encouraging. Coming through COVID, obviously we had the ramp up in COVID with the COVID volumes coming through in pathology. That's washed through, and we're back to a more business as usual, normal operating environment from a top line point of view. Mm-hmm. On the margin side, or the cost side, things are still washing through a little bit, and so there's still a bit of an imbalance. And we find that across clinical diagnostics as well and other healthcare operators in the sector. There's just that little bit of an imbalance still between the revenues normalising and the costs.
It seems to be taking some time for people to get back to their usual patterns of going to the pathologist and having a regular diabetes test.
That's right. So there's been a bottleneck when it comes to GP visitations, and whether that's because people are still loath to get back to the GP after the COVID experience, and or the fact there's a bit of a shortage in GPs at the moment. We've had a controlled immigration intake for quite some time, and that really means a lot of the GPs we rely on to come from offshore haven't been arriving. They are starting to arrive now. And typically they need to be farmed out to regional areas to start with, and metro areas will benefit later. But what we're seeing, because of the shortage, a lot of the regional GPs who have gone through their residency period have moved to the metropolitan area. So we're seeing actually quite a good GP visitation rate in metropolitan areas that the regional areas have been suffering. So that doesn't really impact ACL as much given their metropolitan focus. But when it comes to integral diagnostics, which we own in the diagnostic imaging space, that's been a little bit more of an issue for them. So top line's doing okay. Costs just need to start normalising a little bit. And as we say, that top line should be enhanced by these GP visitations as they improve over time. But we really like both, as you say, strong tailwinds, ageing population. Both are compounders in my view, so longer term we expect them to keep delivering.
And I think one of the other things I like about the sector is the technology, pathology and radiology, both benefiting from technology.
Absolutely.
So the ability to diagnose more things with pathology tests and radiology scans is really seeing the amount of work that these businesses do grow over time.
Well, it's about workflow management. So if you're a pathology provider, enabling technology, investment in systems, AI, IT, allows you to get that workflow. So again, the quicker you can turn jobs around in pathology.
And the valuations for both stocks, Marc?
Compelling, I would say, Simon. So if we look at integral diagnostics, trading on the EBITDA multiple of about 7 times into fiscal 2025.
Which is a significant discount to some of the peer private equity type.
Look at the transactions going across that part of the sector. Multiples are almost double where IDX is trading. Now, IDX is disappointed more recently on the back of a cost update, which was a little bit disappointing, and the stock was off.
But costs are something the company should be able to address in time, and they talked about it.
Look, management's proven a pretty good track record in controlling costs in the past. And clearly, there's been a little bit of an eye taken off the ball, and costs have gone out of control a little bit. But the February result coming up, we should see a very different performance on costs, and certainly
guidance should be a lot better.
And I would expect that.
Australian Clinical Labs and the valuation too.
Australian Clinical Labs trading on a PE of about 13 odd times into fiscal 25, dividend yield of over 5%.
And of course, a very strong balance sheet. That cash they harvested through COVID, that's really managed them to pay down debt.
And what we really like about ACL is its potential to become more of a national player. So in the past, it's been a little bit confined because it's been dominant in Victoria, New South Wales, South Australia.
Yes. But
it's really an acquisition they made a couple of years ago really gives them a national footprint. So again, when it comes to competing for government contracts or national sporting body contracts.
So the national bowel contract, for instance, is a national
government,
contract.
whether it's a NRL, AFL, whatever, or national sporting bodies, the fact that you've got that national footprint means that you're on a more even footing with the likes of Sonic
Yes.
and Helios in that.
And there is a fragmented tail that they could bolt.
Oh, absolutely.
Yeah.
Again, it's about volume, right? So acquisitions are all about bringing more volume onto your
Yeah.
fixed cost network.
Which makes the business either attractive, I suppose, for an acquirer, someone looking to enter Australia, or maybe one of the competitors, or, you know, they've talked about a merger with Helios in the past.
Yeah.
Obviously, they've put that on hold at the moment because of Helios's issues.
Yep, that's
but
right.
that's something that potentially could.
But that volume, issues
very
notwithstanding, that volume is really what's valuable.
And then obviously, Marc, in healthcare, you've been covering Sigma and API, which was a stock we benefited from a couple of years ago.
In that pharmacy wholesale space.
Yeah, so Sigma, why did you like it, and you know what happened last year with making such
well,
attractive
we owned API, and we had a good outcome there with its takeover by Wesfarmers, and so looking at the space again, we thought, what are the players that make sense in that space? Sigma was an interesting story because it'd been through the wars, so to speak, in some way. It'd been going through a heavy capex phase, investing in its distribution centres, and at the same time, it lost a key contract with the Chemist Warehouse Group, where it used to provide the back of shop or ethical drugs to the Chemist Warehouse Group. They lost that contract to EBOS. And so at the same time, you had this heavy capex program, you had a big hole in the earnings appear, and so the stock was an underperformer for quite some period of time. What we liked about it was that at the time we started looking at it, that capex phase had come to an end. So all of a sudden it was about, well, how can they start harvesting some free cash flow as opposed to reinvesting it back into the business to the extent that they had been. And secondly, there'd been a change in management. So Vikesh, who'd come across some Clicks in South Africa, which is a leading pharmacy business in South Africa, assumed the CEO role there, and they gave us a real cause to look at the business and say, well, is this something that we think may start to outperform relative to where it's been? And that's certainly been the case. We think that the offering and the investment in the DCs means that their ability to deliver to their customers has improved.
And also the close historic relationship they've had with Chemist Warehouse has really come to the fore. So
that was something we thought that perhaps they could reconnect, and that certainly proved to be the case when they won that contract back off EBOS.
Yeah, and that's a significant amount of volume that they're now putting through those sheds. Some of those DCs were underutilised. Absolutely. And this volume now increases the utilisation, so all of that profit will drop to the bottom line.
Yeah, and then in conjunction with that, I guess that re-engagement is the fact that what we saw late last year was that a proposed merger between the Chemist Warehouse Group and Sigma has been put forward.
Which is a complete game changer for the business because it now becomes an integrated wholesaler retailer.
That's right.
Produces much more cash. And obviously, you know, Chemist Warehouse, it's a brand that...
Well, it's a powerhouse brand. It's a category killer, it's best in class, not just in pharmacy retail, but in retail more generally. And really the proposition to the customer is it's a discount retail. I think if you talk to Jack Gans at Chemist Warehouse, he talks about loyalty. Really, loyalty is all about price. So you can offer the best price, you generate the best loyalty from your customer.
And that merger's seen a significant re-rating of the Sigma share price.
That's right. So it's done a lot of heavy lifting in terms of valuation. But we're still happy to hold a position.
But it has a lot of the characteristics now that a lot of people look for in terms of it's founder-led, strongly cash generative. I think one of the surprising things of the merger announcement was how underweight Chemist Warehouse was on the New South Wales and Queensland markets in particular, but also the presence overseas. They're in Ireland,
New Zealand.
Yeah, so that really gives them a growth footprint that creates great potential.
It's exciting. As a Sigma shareholder, it's a very exciting development for us.
Yeah, and so why it was a significant contributor last year. It was a pleasing outcome, and just highlights the value for the portfolio and the returns you can generate in the healthcare sector if you can find a good quality business that's trading out of favour, as it looks with IDX and ACL at the moment.
Yep.
Okay, thank you very much, Marc.
Thanks, David.